Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 2. This is Section I. This is a remembering and understanding topic. Identify the criteria for classifying a lease arrangement for a lessor. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then after you watch that, you're going to want to learn more. So make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the member versions of these YouTube videos. Now in today's video, I'm going to be honest, we're going over 5 questions, and there's also just going to be the same 5 questions for members, but usually I create a 10-question version of these videos for members, so you get a little bit more help and a little bit more understanding. Now, the reason that we're only doing 5 questions for both the YouTube and the member version for this one is it's a pretty straightforward topic. We're just going to be learning a few criteria, and this will help us be prepared for some of the other topics that we're going to cover in future videos when it comes to leases. So again, we're only doing 5 questions today for YouTube and for members, but remember, Superfast CPA Pro members typically get access to the full 10-question version of these videos so that they can get a little bit more help and a little bit more understanding. So if you like this and you like our other stuff, check out becoming a pro member. Now with all that said, let's dive straight into the questions. All right, here we are at question 1. And as I said, we're just going to be going over some criteria in this video. We're not really doing anything too crazy. We're learning about how to classify a lease specifically for lessors, because what you've probably seen in FAR was more focused on lessee, or at least a little bit more. So now we're going to be focusing more on lessors. So let's go through this. If a lease agreement specifies that the leased asset's ownership will transfer to the lessee at the end of the lease term, how should the lessor classify the lease? Okay, is it always going to be an operating lease? Is it going to be a finance lease? Is it a direct financing lease, or is it a sales type lease? Now, if you have done FAR, you might have an idea of what this would be, or at least you have a guess. So maybe take a second and think about that. But if not, if you have no idea how to classify a lease, especially when you're the lessor, that's okay. That's what we're using these questions to learn. So let's go ahead and take a look at the explanation together. All right, here we are. The answer is D, as a sales type lease. Now, if you have seen stuff like this before, you might have thought it was a finance lease, which technically it is a finance lease, but it's really a sales type lease, which is one of the 2 distinctions that there can be when it's for a lessor as a finance lease. So to make sure that's a little bit more clear, as a lessor, it's still going to be an operating or a financing lease, but there is a little bit of an extra distinction where there's 2 types of financing leases underneath the lessor. It's either a sales type or a direct financing type. And we're going to talk about how to determine that in this video. For a lessor, if the lease agreement transfers ownership of the asset to the lessee by the end of the lease term, it meets the first finance lease criterion under ASC 842. And there's multiple criteria that we're going to be talking about throughout this video. And you don't necessarily need to remember ASC 842, but that's what this is falling under. The lease would then be classified as a sales type lease. So because there was an agreement that's going to transfer ownership at the end of the lease, this is going to be a sales type lease. Now let's go to the next question to learn another criteria. All right, here we are at question 2. Which lease classification should the lessor apply? And you might have just noticed that I read the last sentence first instead of reading through the whole rest of the question. And that's because we have a strategy that we like to tell people, and that's to read the last sentence of a question first. Now, of course, in the previous question, it was just like 1 or 2 sentences, and that's not really useful at that point. But this is a very good habit to be in for especially exam day, because you have no idea what you're going to be seeing on the questions. So it's good to read the last sentence first to see what the question is talking about, to kind of get that context that you need to then read through the rest of the question and already have an idea of what you need to be looking for. So again, read the last sentence first. It's helpful for getting context. So again, which lease classification should the lessor apply? A lessor leases equipment to a customer for 5 years. The contract allows the customer to buy the equipment at the end of the lease for $1,000. The equipment's fair value at the end of the lease is expected to be $20,000. The customer is not required to buy the equipment, but both parties agree it is very likely the customer will do so. So again, what is this going to be? Is it going to be an operating lease? Is it going to be a sales type lease that we just talked about in the previous question? Is the lease classification unable to be determined until the end of the term? Or is it a direct financing lease? Now, again, if you have seen any of this before, you might have an idea. But if not, that's okay. We're learning just more of the criteria for leases. So let's go to the explanation right now. All right, here we are at the answer B, sales type lease. So it's a sales type lease again, but it's a different criteria. And you'll kind of see a pattern throughout this video. You'll start picking up. If a lease includes a purchase option that is reasonably certain to be exercised, such as a bargain price compared to the asset's expected fair value, it meets one of the finance lease criteria. And again, because it's a lessor, if it meets that criteria, it's going to be a sales type lease. And we're kind of seeing a pattern here. I'm not going to give too much away. We're just going to go through the rest of the questions to kind of make sure that you get all this. But again, it's a sales type lease because of a different reason, because there's a purchase option that's reasonably certain to be exercised. Now let's go to the next question. All right, here we are at question 3. How should the lessor classify this lease? Let's go up to the top. A lessor leases machinery with a 10-year economic life to a customer for 8 years. At commencement, the asset's fair value is $100,000 and its carrying amount is $70,000. The lessor expects to collect all payments. So how should the lessor classify this lease? Again, is it an operating lease? Is it a sales type lease? Is it a direct financing lease? Or is the classification not able to be determined until the end of the term? So think about this. You probably are starting to notice a pattern, so I might have just given it away. But again, give this a try, and when you're ready to come back, we'll look at the answer together. All right, here we are. The answer is B, a sales type lease. And again, you're seeing a pattern here. This is just a different way for it to be a sales type lease. An 8-year term out of a 10-year life, so that's 80% of the life, is a major part of the economic life, which is one of the 5 criteria. And you just saw there's 5 criteria that could be met to become a sales type lease. So, that gave something away there. For a lessor, meeting only one criterion equals sales type. The fair value being greater than the carrying amount simply means there's a selling profit recognized at commencement. It doesn't decide sales type versus direct financing. And you might have thought maybe it would have been a different thing because the fair value is over the carrying amount, but that actually doesn't affect if it's a sales type or a direct financing lease necessarily. So again, in this question, we learned another one of the criteria, which is that if the lease is for the major part of the economic life of the leased asset, then that is going to be a sales type asset for the lessor. And again, if any one of these criteria is met out of the 5, and we've only talked about 3 so far, but if any one of the 5 criteria are met, it is a sales type lease. So again, you'll kind of be seeing that throughout the rest of this. Now let's go to the next question. All right, here we are at question 4. How should the lessor classify this lease? Let's go up to the top. A lessor leases equipment with a fair value of $120,000 and a carrying amount of $120,000. Term is 5 years, the implicit rate is 6%, and the present value of lease payments is $114,000. The economic life is 7 years, and the collectibility is probable. So how should the lessor classify this lease? Again, is it going to be a sales type, an operating lease, a direct financing lease, or can it not be determined until the end of the term? So you can probably guess what the answer is going to be. So let's just go ahead and go to the answer right now. All right, here we are at the answer. A, sales type lease. Again, you're probably noticing a pattern. You probably could have guessed the right answer, but this is just another one of the criteria. Here, the present value of the payments is $114,000 and the fair value was $120,000. That means that the present value of the payments is 95% of the fair value, which is substantially all of the fair value, and that is another one of the criteria. It's basically, if the present value of the payments is substantially all of the fair value, then that means it's going to be a sales type lease. And that one's a little bit arbitrary. It doesn't have to be an exact number, but usually the trigger is 90%, usually. But that's like not 100% of the time, but you can kind of think of it like that as a general rule of thumb. If the present value of the payments equals 90% or more of the fair value, that is considered substantially all of the fair value, so it's going to be a sales type lease. Again, that's number 4 of the 5 criteria. Now let's go to the next question. All right, here we are at question 5. How should the lessor classify this lease? Let's go up to the top. A lessor leases standard office furniture for 3 years. The economic life is 10 years. The fair value and the carrying amount are both $50,000. The present value of lease payments is $20,000. The lessee does not guarantee any residual value. An unrelated third party guarantees the end of term residual to the lessor with a present value of $25,000. The asset is not specialized and can be released. Collectibility is probable. So how should the lessor classify this lease? So this one sounds quite a bit different than the other 4 as far as what's being said here, but is it going to be a sales type lease again? Or is it finally an operating lease or a direct financing lease? Or can the classification not be determined this time? So think about this, pause the video, think about what we've learned throughout the rest of the video, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. C, it's a direct financing lease. So, you might have thought I was maybe trying to trick you there, that it was still a sales type lease, but it's not. It's a direct financing lease. So let's go through this. None of the 5 criteria are met, and we've been talking about 4 of these so far throughout the video. There was no transfer of ownership, which is one of them. There is no bargain option. It's only 3 years out of the 10-year life, so that's not a major part of the useful life. The present value of the payments alone is only 40% of the fair value, which is definitely not substantially all of the fair value. And this is the final one that we haven't covered yet, but I just wanted to kind of throw it in here. There's no alternative use. So if it's a specialized product that will have no alternative use other than what it is being used for, then that's the 5th criteria for it being a sales type lease. But in this case, that is not the case. The asset's not specialized and it can be released. So that criteria wasn't met either. So none of the 5 were met. But now there's 2 criteria for direct financing. For direct financing, you look at the third-party guaranteed residuals, or really just the residual value. If there is a residual value, you add that to the fair value, so $20,000 plus $25,000, and you add that to the present value of the lease payment, and that gives you $45,000, which is 90% of the fair value, which is $50,000. So in this case, because there was that residual value that was able to be added to the present value of the lease payments, that brought it up to being substantially all of the fair value, and the collectibility is probable. So just in case it's not clear there, or a direct financing lease. If none of the 5 criteria are met for it to be a sales type lease, but when you add the residual, the present value of the payments plus the residual ends up being substantially all of the fair value of the asset, and if the collectibility is probable. So if those 3 things happen, where it's not a sales type lease, but the other 2 things are met, and they both have to be met, then it's a direct financing lease. If only one of the direct financing lease things is met and not the other one, or if none of the sales type and none of the direct financing lease criteria are met, then it's finally an operating lease. So that's why it's a little bit more complicated when it comes to lessors compared to lessees, because with lessees, it's just financing or operating. Financing if it meets any one of the criteria, operating if it doesn't meet any of them. But when it comes to lessors, there is 2 types of financing leases that we've been talking about throughout this. Sales type, where if it meets any of the criteria, it's a sales type. But if it doesn't meet any of the 5 criteria, but then it still meets the direct financing lease criteria, then it can be a direct financing lease. And then finally, if it doesn't meet any of those, then it's an operating lease. So that's what we were trying to go over in this video. Now, before we do anything else, let's do one more part of the Superfast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the different criteria for a sales type lease, or about a direct financing lease, or whatever the case is. Again, you notice these things throughout the questions, and so you take a moment and write them out in your own words as the pillar topics, the key things that you learned from the questions. And as you do this each day, you are building your own personal repository of the most important things you learned from the questions so that you are prepared for the exam. So let's go ahead and take a look at the pillar topics for this video. Okay, here we are at the pillar topics, and it's a little bit smaller than usual because, again, this is pretty straightforward once you understand the criteria. So let's go through this. If any of the 5 criteria are met, so again, just one of them has to be met, and it's either transfer of ownership, reasonably certain purchase option, major part of life, present value of payments is substantially all of fair value, or there's no alternative use, a lessor classifies the lease as sales type. So if any one of those is met, it's a financing lease that is a sales type lease. Now let's go to the next one. A direct financing lease applies only if none of the 5 criteria are met and the present value of payments plus any lessee or third-party guaranteed residual is equal to or greater, or, meaning substantially all of the fair value, and collectibility is probable. So again, direct financing lease, none of the 5 criteria for a sales type lease, and the present value plus residual is equal to or greater than substantially all the fair value, and collectibility is probable. And then finally, if those direct financing conditions aren't met either, the lease is an operating lease. So with that, that is the end of the YouTube version of this video. Remember, if you become a Superfast CPA Pro member, you typically get access to the full versions of these videos, where I typically go over 10 questions compared to the 5 questions on YouTube. Now, again, to be honest, for this video, we're only doing 5 questions for YouTube, and it's the same 5 questions for members because this is such a small, kind of straightforward topic that is going to be kind of laying the groundwork for the future videos that we're about to do. But usually, Superfast CPA Pro members get access to the full 10-question version. So if you like this, make sure you check out becoming a Superfast CPA Pro member. And the easiest way to do that is by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and it will give you a better path to learning about and becoming a Superfast CPA Pro member. So check out the webinar, check out becoming a pro member. I hope that you liked the video. If you did like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.